Hello, hello, hello. Stephen Morris here with Advisory, bringing you the hottest and latest on real estate taxes and real estate taxes. So let's dive into another interesting area. I think it relates to you folks that are working on major structural improvements or major structural repairs to your building. And what does that mean in terms of your tax outcome? Let's work with an example. That building that you've owned for the past 10 years has a roof problem, and you know what? Rather than patching it all the time, it's better to just take the roof off and replace it completely. And the cost to get there is roughly around $50,000. The question I have for you is, what about the old roof? You know, when you bought the property, it came with the walls, a foundation, and also came with a roof. And are you still depreciating that roof after you've installed a new roof? That would be considered to be like a ghost asset, and that doesn't seem to be quite just. Why would we be depreciating something that doesn't exist anymore? Is there an opportunity for us to be able to deduct the cost of the old roof immediately and retire it while still maintaining the rest of the building and now depreciating the brand new roof on the building? The answer is yes, there is. And fortunately, we have Treasury Regulation 1.168I-8, which gives us clarification on what it means to have a partial retirement of your property. Let's give you a few examples of how this works and what the mechanisms are around it. So let's say you bought a building for $1 million, and like I said, after a few years, the roof is starting to come apart on you and you replace it. When you bought the building, you didn't buy 4 walls and valued each wall, then you bought the roof, and then you valued the roof, and then you bought the foundation system, and the foundation, and then you bought the cabinet. You just bought a building. And we do talk about cost segregation studies in our other videos where you get to separate out or segregate those costs which are part of the building as defined in the regulations, versus the property that is not considered part of the building, which would be eligible for immediate bonus depreciation. However, in this case here, the roof is still part of the building. We don't know what the value of the roof is as it relates to the entire structure. Fortunately, the IRS allows you to use something called the Producer's Price Index. And the way it basically works is we're gonna take the cost of the new roof that you put in, for example, and then what we're gonna do is discount it back to the time of your acquisition. So let's say 5 years have passed and there's a rate of, let's say, 5 or 6%. And over 5 years, let's say your $50,000 it costs today would have been worth, let's just say $30,000 or $32,000 in 5 years ago terms. Okay, that amount would be the one that's immediately deductible, and you get a partial deduction for it. You have to take an election on the tax return to be able to do this write-off. And once you do that, you'll be able to get an immediate expense deduction. And then of course the new roof would come into service and be depreciable over its existing life, 27.5 or 39 years. Finally, one more thing I should point out is because this is an election, this is not something you can resolve later through an accounting methods change. So you'd have to resolve it, let's say it was on your 2024 tax return. You got to make the election on 24 and take the partial deduction in 24. You can't go back in year 2029 or 2030 and say, oh my gosh, I should have retired the roof that I replaced back in 2024. Let me throw out a form 3115 for a change in accounting methods and resolve it there. That won't work. Now, if you missed it within the last 3 years or so, then you can go back and amend the return and take care of it at that point. But outside of that, the accounting methods there is not there to help you. Whereas in a cost segregation study, for example, that we love to prescribe, those you can absolutely do with an accounting methods change, and we do Form 3115s all the time over here, and that's how you generally resolve those issues. So I just wanted you to be aware of this and that there is this concept of being able to write off some of the building if you replace a substantial portion of it. The roof, of course, is a typical one that most people would replace, but if you're replacing certain walls or you have to, burn out some of the foundation and rebuild it, those are absolutely eligible costs as well. And we would generally use the Producer Price Index in order to back into what the value of those old systems that you paid for were. So if you'd like to know more about how this works functionally, or if you're considering doing a substantial renovation and building up your property into something that's more compliant with the code today, then we'll be more than happy to walk you through what the tax outcomes are through this link over here. And if you have any other questions, feel free to reach out to us. Thank you so much for watching. So make sure to like and subscribe to our channel for all the content related to real estate investment and tax saving strategies.